All right, can you hear me on Zoom? All right, good, thank you. All right, let's get started. You guys want to review the exam? All right, I heard at least one yes. All right, let's quickly run through the exam. And then if you have any questions on it, you're welcome to come to office hours. I'll be in my office today. So if you want to come, just come in person and I can run through your exam with you. There were two versions of the exam, version A and B, and but they were roughly the same. I think they might have all been the same, even the numbers. So they were just mixed up. All right, let's go through this. Actually, maybe I can't write on this, so maybe I will open up. I need to write. Maybe I'll just add something here so that I can scribble some things if I need to. And I need to do this. Jump back and forth. All right, I'm just going to start working through them. I'm going to go pretty fast. Stop me if you have questions. Otherwise, I'll move quickly. All right, make this a little bigger. So you buy one Snap August 50 call contract and one Snap August 50 put contract. What strategy is this? Has everybody already forgotten? It's a straddle. Okay, there we go. Good. Assume that the contract has a multiplier of 100. The call premium is $2 and the put premium is $4.50. Your maximum potential loss from this position is what? So it's a straddle. What's the most that you can lose from a straddle? Yeah, the premium. Remember, a straddle looks like this, right? And so it's just the premium. So we're going to add those up. 2 plus 450, that's $6.50. Multiply it by the 100 multiplier, you're going to get a $6.50 loss. Okay, so that one is D. All right, let's go to the next one. The image below is the profit loss diagram on a covered call. The underlying stock was purchased at price 45. So it was, again, I'm sorry, I can't write on this, but maybe you can see the cursor there. Was purchased at 45. What was the strike price and premium of the call used in this covered call? So the first one, what's the easy one? What's the strike price? We can just see where the diagram changes. Strike price was 50. All right, and so what did the premium have to be? If the stock was originally purchased at 40, it's already up $5, so you would have been here, but you also got the call premium, which is going to move you up another $10. Sorry, another $5. So the call premium must have been $5 as well. So we're going to have strike 50, call premium $5. So I'm going very, very quickly through this. So stop me if you want me to do it in more detail. But that one would have been B. All right, assume that you purchased a covered call by going long a share of the underlying stock at price 20 and writing a call with strike 24 for premium $3. If at expiration you break even on the covered call, then the underlying stock price is what? What is the break even on a covered call? I don't know if you remember the formula. I'm having to remember these off the top of my head. It's going to be the price of the stock, what, minus the premium. So if you look in your formulas, I hope that's right. Price of the stock minus the premium, that should be it. So we're going to get $17 And then the underlying, okay, and then the call is what if you're breaking even? Let's do the picture again. So it's a covered call here, you're break even. Are you in the money or out of the money for the call? The call strike is right here. So if you're at the break even point, are you in the money or out of the money for the call? Somebody tell me. You're out of the money, right? Because the strike is here and the call looks like that. I have a feeling I've already lost everybody, which isn't a good feeling. Like 3 minutes into class and everybody's already gone. No, I didn't review on Monday of the exam. Is this like punishment to go over this? It's like you want to just put it out of your mind, like. I know it happens to me too. You go through an exam, right? And then it's like, if you don't have to retain that, it's like your mind just says, dump it now. I don't know. Is that what yours does? That's what mine does. You can, okay. But I thought it would be good to review. If you don't want me to review, well, let's keep going. And then if it gets too painful, then we'll give up. Okay. The common stock of Avalon Corporation has been trading in a narrow range around $40 per share for months. You believe it's going to stay in that range for the next 3 months. What option strategy would make the most sense? It's trading in a range. Which one here? Butterfly spread. Butterfly spread. Yep. Okay, good. Hopefully everybody got that one. All right. Assume that you've purchased a share of stock at a price of 50. You want to protect against a drop in the stock such that your maximum loss will be at most $8. You see the following put options available in the table below. What action should you take? So number one, you're going to be buying a put, right? That's how you protect yourself. That's the protected put. So I can get rid of A and C. It's B and D. And then the only question is, I want my maximum loss to be $8. I bought it at 50. So I look at these two different ones. Buy the put at strike 45. So if I buy it at 45, then what is my maximum loss just on the stock price going down? It's $5. Plus I'm going to have to pay the put premium. So that brings me up to $8. That would be my maximum loss. So that's the answer. Everybody okay with that? I'm just going to keep moving along. Let's just stop me. Okay. A writer of a call option will want the value of the underlying asset to what? You wrote a call option. So what does your diagram look like? You wrote a call option. It's going to look like that, right? So what do you want the stock to do? Yeah, go down. So that's going to be decreased. So it's going to be either A or C. Okay. The buyer of a put option. You're the buyer of a put option. You look like that. So what do you want the stock to do? Decrease. So A. 6 is decrease and decrease. All right, you purchase a call option for $4 at expiration. You calculate your profit loss from this option trade, and it's $6. Okay, if the strike price of the option was $30, then the price of the underlying stock at expiration must have been what? Okay, so this one we got to back out a couple of things. You paid $4. Your profit or loss from this option trade is $6. So how much in the money was the option at expiration? $10. So we know that we were $10 in the money. Does everybody see that? Because we made $6, and that's because we were taking into account the $4 that we paid. So overall, we had to be $10 in the money. If the strike price of the option was $30, then what was the price of the underlying stock at expiration? It must have been 40. That's that $10 into that. All right, when you buy a European call option, the option gives the buyer the right to what? It's a call, so it's buy the underlying asset only at the expiration date. That's the European option. Hopefully everybody got that one. Which strategy benefits from upside price movement and has some protection should the price of the security fall? A long put, a butterfly spread, a bull spread, or a short call? If you're long a put, you're going to lose money. Which strategy benefits from upside price movement and has some protection should the price of the security fall? If you're long a put, so you're long a put. Yeah, you're long the put. This is what your profit or loss looks like, right? This one here. So do you benefit from upside price movement? No. I was trying to think, like, do I have this wrong in my mind? Wait a second. Okay. So which one is it? It's the bull spread. It's the bull spread. So the bull spread looks like this. Are you going to benefit if it goes up? You've got some protection if it goes down. All right, you're long a European put option. It has a strike of 50 and expires in 2 months. If at expiration, the underlying stock price is 48, then the payoff of this put, we're talking about payoff is what? This should be an easy one. Just talking about the payoff, not profit or loss. $2, right? Just plug into the put payoff formula. All right, a trader buys 2 shares of stock at the initial price of 50. At the same time, the trader writes 3 call options on the stock with strike price 45. Each option has premium $8. If the stock price at expiration is 52, calculate the trader's profit or loss. So this one, I just wanted you to do just a general profit loss calculation. So you're long 2 shares of the stock, but let's do that. So the stock, remember our formula is ST minus S0 for the stock, and I'm long 2 shares. And then I am short 3 call options. So I'm going to have a -3 on the call options. And I just need to do this calculation. Okay. So I'm long the stock. What did the stock end at? It was 52 and I bought it for 50. 52 minus 50 minus the 3 calls. Let's look at the payoff of the call. The call had strike 45. Stock price at expiration was 52. What's going to be the payoff of the call? $7. And the price of each was 8. So payoff is 7. Price was 8. So I'm going to get 2 times 2, going to get 4 there, -3 times -1, 4 plus 3 or 7. So the answer is C. All right. So I buy 1 August 50 call contract and buy 1 August 50 put contract. I've got a straddle here. The call premium is $2. The put premium is $4.50. Your strategy will lose money only if the stock price is blank at expiration. So this is a straddle. We're long a straddle. Straddle looks like this. And here's our strike. And it's asking for the break even. It's if we're in between the break even. And it's going to be the strike plus the put and call premium, and the strike minus the put and call premium. Okay, so those were the break evens for a straddle. So it would be between, what is it? I think it's this C right here, because 50 is the strike. The total price was $6.50. So if it's between these two right here, then we're in that zone where we're going to be losing money. We're down here. Yeah, on either side. Yeah. Yeah. Now you could have gone to the I don't have, sorry, I don't have the benefit of the formula sheet in front of me. You guys had that, right?
I don't think you gave us the back.
No, I didn't give them to you back. No, I'm not saying right now. Yeah. I'm saying on the exam. Okay. Assume that you short a single put option with strike 40, premium 3, and 3 months to expiration. If at expiration the price of the underlying stock is 38, what's the profit or loss on your short position? So again, if I want to do this carefully, I've got a put option. I'm short a put option. It's just minus the payoff of the put minus the price. And let's look, what is the payoff of this put? Strike is 40. It ends up at 38. So what's the payoff? $2, and the premium was $3. 2 minus 3, I'm going to get positive 1. So that's B. Consider the writer of a European call option with the strike price 44, expiration 2 months, premium $2. If at expiration the underlying stock is 45 and the holder of the option chooses to exercise the call, this means that the writer of the option must what? Okay, so this is just, do you know the basics of a call contract? Okay, so strike is 44. If the person exercises, that gives them what? The right to buy at 44. That means the writer must sell to them at 44, right? So sell the underlying stock for $44. So that would be C. All right, you open up your trading platform. You see a snap put with strike price of 35, price of $2. Well, a call with strike of 35 is priced at 350. The maximum per share loss to the writer of the put is what? And the maximum per share gain to the writer of the call is what? Let's start with the easy one. Per share gain to the writer of a call option. If you write a call option, what's the most that you can make? What's the best scenario for you? You sell a call option and you hope they never exercise it. Then you just collected the premium. Okay, so the second one is going to be the premium of the call. It's the $3.50. So that gives us down to C or D. Then we have to go to the maximum per share loss to the writer of the put. What is worst case scenario for a put? If you're the writer of a put. So if you're long a put, it's going to be like that. If you're the writer of a put, it's like that. And worst case is when the stock goes to 0. Okay. So, and if it goes to 0, then what's going to happen? What's going to be your loss? The strike price is 35. Okay, so you're going to have to sell at 35, something that's worth 0, but you got $2 for selling it. So your net loss is going to be 33. So it's going to be C here. All right, 16 is an easy one. Payoff diagram represents what position? Long a put with strike 50, right? That's an easy one. Long a put with strike 50. All right. Consider the widget exchange. There are 3 traders, A, B, and C. Over one day, the following trades occur. So this one was going way back to just calculate open interest. We can quickly do this. I always like to set up a table for this. So I'm going to set up a table here for A, B, and C. And these are my trades. Trade 1, 2, and 3. Let's just quickly write them down. The first trade is A is long, B is short, 3 contracts. Wait, was it B or C? Did I just put them in the wrong place? I just put it in the wrong place. So that's trade number 1. A acquires 3, B shorted those. Trade number 2 is C goes 10 long, B 10 short. And then the final one here is A goes long, C short, 2 contracts. It was A long, C short. And so then we can get their totals, what they have at the end of the day. So A ends up 5 long, B ends up 13 short, C ends up, what did I do wrong here? This has to be a 2. Yep. And so this is 8. And so the question is, what is the open interest? So what's the open interest at the end of the day? Does everybody remember what the open interest represents? Number of contracts, number of open contracts. How many open contracts are there? 13. 13 total. So that's A. All right, you write a call option. At expiration, you calculate your profit or loss and find that you lost money on the overall trade. At expiration, the call must have been what? Let's look at this. You wrote a call option. So what does your diagram look like? It looks like that. You wrote a call option. You lost money. So that means you're over here somewhere. So the call option must have been what? In the money. Yeah, right, because I'm above the strike. The call was in the money and I'm the one who wrote it. So in the money is the answer to that. All right, you go long, 1 November 85 call contract and short a November 90 call contract with premium $6. Each has a multiplier of 100. If at expiration, the price of a share, the underlying is 89, your profit would be what? So here, what is it? We are long a bull spread. We're long the 85 and short the 90. So it's a bull spread. So I'm long and I have the contract multiplier. And this is my, I'll call this 1. This is, or you know what, I'm going to put a little, what was the strike? 85. So just to indicate this is the 85 strike. And then I'm short the 90 strike. That's supposed to be a 90. So all I need to do is just calculate my profit or loss here. So the 85 strike ends up in the money $4. The premium was $8.50. And the 90 strike out of the money. I don't remember what the premium was. $6. So I'm going to do this calculation, whatever this is. So this one's going to be what? Minus 450 minus plus 600. Did I do that right? See if that's one of the answers. 150. Yep, D. All right, we're getting there. Got 8 more problems. All right. You write a put option with strike 70 and premium 3. The break-even price on your position is what? We know the break-even for a put. It's going to be 67. 67, right? Looks like that. So it's below the strike. All right, next one. You decide to buy Apple stock and purchase a put option on the same stock. This strategy is called a what? Is buying a put to protect yourself? A protective put. The most risky transaction to undertake if the stock market is expected to fall substantially after the transaction is completed is which of the following? Which one is going to do poorly if the market falls? Okay, so writing an uncovered call, buying a call, buying a put, writing an uncovered put option. Which one's going to do poorly? D, right? Writing the uncovered put option. Just look at the payoff of that. All right, a put option selling for a premium of $5 has a strike price of 20. If the underlying stock price is 17, then this put option is what? In the money, out of the money, at the money. In the money, in the money, the strike is above the current price. Doesn't matter. Doesn't matter. Yeah. Doesn't matter. All right, you see a put option with a strike price of 22 and a premium of 6. The current price of the underlying stock is 20. What's the time value of this option? So what's the time value of the option? Let's remember, what is time value equal to? Time value is equal to the premium, right, minus the intrinsic value. And the intrinsic value is just the payoff value, right? So the premium is $6. What's the intrinsic value? The intrinsic value is the exercise value. It's a put option. Strike is 22. Current price of the underlying stock is 20. So its exercise value would be what? Its intrinsic value would be $2. 6 minus 2, or we're going to get $4 for the time value. So that's D. If you decide to write a naked call option, what is your max potential loss of writing a call option? Writing a call option, unlimited. All right, the premium of a put is $8. The time value of the option is $2.50. And the current price of the underlying stock is 33. What must be the strike of the option? Let's go back to this time value, and we want to know the strike. I'm going to flip this around. Intrinsic value is equal to the premium minus the time value. So let's get the intrinsic value. So the premium is $8. Time value is $2.50. 8 minus 250. So I'm going to get 550 is the intrinsic value. Okay, and current price of the underlying stock is 33. So how do I calculate the intrinsic value? It's the payoff value, and I'm talking about a put. So a put, let's remember the payoff value of a put, it's the max of 0 or X minus the stock price. Right, and here it's because it has intrinsic value, it's going to have to be the in the money case. So I'm going to have X minus the stock price needs to equal $5.50. Let's see which one we were given. We're asked for the strike. We were given that the underlying is 33. So X minus 33 is equal to $5.50, or X is going to be $38.50. 38.50 right there. All right, only 2 more left. Consider a butterfly spread using call options with strike 25, 30, and 35. The option premiums are 830, 450, and 220 respectively. What is the cost of the butterfly spread? So butterfly spread, remember, what do? You buy the 25 strike, sell 2 at the 30 strike, and buy the 35 strike. So I'm going to buy the one at the first strike. I'm just going to call it C1. I'm going to sell 2 at the second strike, and I'm going to buy at the third strike. What is going to be the total cost of that? 830, 450. So it's going to be 830 is the cost of the initial one. The second one, those were 450. What was the last one? And then I have to buy at 220. So what is this? 830 plus 220, that's 1050 minus $9. I'm going to get $1.50. Hopefully I did that right. $1.50 right there. All right, last one. You hold a share of Tesla but are concerned that a crash may occur. You don't want to sell your share in Tesla. The best way to protect your position is what? Buy a put. Okay. I went through that pretty quickly. Again, if you have any questions about your specific exam, come to office hours. I'm happy to go through it with you. All right. Let's get back to our lectures then. Let me just mention one thing here. I posted the homework. Let me show you that. So down here, our fourth homework. I posted that's going to be due next Wednesday if we get through all the material. Okay. But anyway, that's been posted, so make sure you're aware of that. All right, let's go back. Let's pick it up where we were last time. And we were talking about put call parity. So put call parity is probably one of the first big sort of pricing results. And so let me remind you of that. It's a very, very important one. It's one that markets adhere to very, very closely as well. And we'll see why today. If markets don't adhere to it, there's going to be an arbitrage opportunity. So let's go down and let me remind you of what put call parity said. So put call parity was right in here. And then the formula is really the important part, the formula right here. But put call parity basically says the following: European puts and calls with the same strike and same expiration are not independent. They're not independent. They cannot be priced independently. Okay, and so there's actually a relationship that must be satisfied. Here's the relationship. The relationship says the call premium minus the put premium plus the strike price discounted must be equal to the stock price, the underlying stock price. Okay, and if you remember how I did a derivation of this, I did it by matching payoff diagrams. And so we had in red here, we had the payoff diagram of a single share of stock. And I said, look, I can replicate that. I can basically create it by going long a call, short a put, and then adding a risk-free bond. Remember, what a risk-free bond does is it shifts the diagram up or down, and I could match the payoff of the stock. And I said two things that have the same payoff must have the same price, right? Otherwise, there's going to be an arbitrage opportunity. So that's what we said. And I did an example of this. Let me remind you of the example because I'm going to come back to it in a second here. In fact, I think where we ended, the next thing that I was going to do is I was going to revisit this example. So let me remind you of this example because we're going to come back to it very quickly. So just a numerical example. Assume that the stock price is $40. So I know the stock price. I have a risk-free rate now, and I need that because there's discounting that occurs in put call parity. That's this part sitting right here. Time to expiration is 3 months. If there's a call, and I know the call premium, $2.78, put call parity says, then you know what the put premium has to be. Okay, it cannot be priced at anything else. You know what it has to be. And what tells you what it has to be? Put call parity. So we went down, we wrote down put call parity. We were given the call price, the strike price, risk-free rate, time to expiration, and the stock price. All we were left with to solve for was the put price. And we solved and we saw that the put was $2.02. Okay. So we're going to come back to this example in a second. So remember, put call parity says the following. It says, you look in the market, you look at the price of a call, I can tell you what the put price has to be. Can't be anything else according to put call parity. The put price must be $2.02. That's what put call parity says. By the way, later, after I go through the example, if you want, I'll do this if you want, we can pull up some option prices, and we can do a little calculation and see if put call parity is being satisfied or not. Okay? It should be satisfied. We're going to have details like bid-ask spread and what's the exact risk-free rate, but it's going to be very close. You'll see that markets satisfy this. And here's why. So we mentioned that the philosophy behind this is pricing by no arbitrage. Let me remind you of what an arbitrage was. It was a situation in which one can generate a positive cash flow. Positive cash flow is where you receive money, right? And you receive money in a number of ways. If you buy a stock, when you sell it, you receive money. If you buy a bond, when it matures, you receive money. But an arbitrage is where you receive money, but you never made any net investment. That means you never actually had to use any of your own money to invest in anything, but somehow money just flows to you. So that's an arbitrage. Think of an arbitrage as too good to be true. Too good to be true when you hear the term arbitrage. I always say an arbitrage is a free lunch, but this is a bad thing to say for college students because they're really good at finding free lunches. Because it's supposed to be there's no such thing as a free lunch. And that's why you're supposed to say arbitrage should not exist in markets, or at least that's the notion of people saying an arbitrage is a free lunch. All right, so our pricing philosophy is what we call absence of arbitrage, meaning that in well-functioning markets, arbitrage should not be possible. Okay, and one example of this, and this is the one we tend to use a lot, is called the law of one price. The law of one price just said the following: two portfolios with the same payoff must have the same price, otherwise there's an arbitrage. And we went through that last time. We just gave an example, and the P here was not for a put, sorry, it was for a portfolio. But we said, let's assume there are two portfolios that have the same payoff, but different prices. How would I arbitrage? And what do you always do to arbitrage? You buy the cheap one and you sell the expensive one, okay? And so that's what we did. Our arbitrage strategy was buy for the cheap price and sell for the expensive price. And we showed that if you do that and you net out all your cash flows from that, you get an arbitrage. You end up in a situation where you make money, but you never, ever have to invest anything. You never have to use any of your own money. And that would be an arbitrage. All right, so that was sort of big picture, high level thinking of that's a principle that financial markets should satisfy. There should be no arbitrage in markets. So what we're going to do is I'm going to show you that put call parity is an absence of arbitrage relationship. That is, if put call parity is not satisfied, somebody can arbitrage. So let's go and we're going to revisit our example. So let's start here by revisiting this example. So let's revisit a put call parity example. That we did before. Okay, and let me just remind you from that example, reminder, we had that by put call parity, I'm just going to call it PC parity. I don't have to always write put call. By put call parity, we calculated, okay, we calculated that the put premium should have been $2.02. Okay, that's what I go back to that example that I just showed you. And that was our answer. Put call parity said the put must be priced at $2.02. Okay, so the question for every, when you do finance and investments, especially investments, my question for every theory that I get that somebody tells me is, you know, whether it's CAPM or anything like that, somebody is trying to tell me, okay, this is the fair price. And you should always ask, well, if that's not the price, what's going to happen? So what, right? You can tell me your theory. You can tell me theoretically, the stock should be worth $80. And I say, well, but what if it's not? What if I see it for $50? What good does your theory do me? Okay, that's always a question you should ask, because then if they say, oh, well, it's just a theory, you can't really do anything with it, you're like, okay, how does that help me? But this theory here is one, like option pricing and all this stuff is a much stronger theory than things like CAPM that you see in other classes. Why do I call it stronger? Because we're going to see here, if it doesn't follow put call parity, I'm going to give you a specific strategy that you can perform to make money. Okay, So that's what I like about this subject. It's not just, oh, that's a theory, okay, so what? It's like, okay, if that is not followed closely, here's a strategy on how to make money. So I always thought that was a good thing about this theory. All right, so put call parity says, hey, I calculated it. My theory says the put should be $2.02. Okay, so let's ask, well, what if it's not? What if it's not? What can I do? So, however, let's assume the put price in the market, that is, I go and look in the market and I see the actual price is $1.50. So you know what? I don't want to have P0 and P0 floating around. So I'm going to call this one, maybe just to help me here, I'm going to call it P0 super M, meaning that's the market price. Okay, so I look in the market and I look up a quote and, $1.50. Wait a second, put call parity says it's supposed to be $2.02. The market is only selling for $1.50. So then the question is, so what? What can I do with that? It's violating the theory. Then does the theory help me? So what we have here is we have, put call parity is violated. Okay. So it's gonna turn out if put call parity is violated, that means an arbitrage opportunity is available. So we can arbitrage using the law of one price. Okay, so how are we going to do this? I've got this theory here. It says it should be $2.02. I look in the market. It's not $2.02. It's $1.50. How can I take advantage of this? Okay, so we're going to use the law of one price. And let's remember what put call parity said. So here, let's do our put call parity formula. Okay, and so put call parity said the following. Now remember what we did, we matched payoffs. It says I'm looking at the payoffs at expiration. And remember we had the following relationship. We said long a call, short a put, long a bond with face value equal to the strike was the same as the payoff of the stock. Okay, and if you remember, I always think of the little picture in my mind. It says long a call, short a put, right? And then raise it up by X, and you have the same payoff as the stock. So I can rearrange this. By the way, so let me help you. When you look at this formula, formulas that we get here correspond to portfolios. Okay, and that's going to be a key connection. So this formula, when I see this formula, what do I think? I think long a call. Why? Because the coefficient is positive 1. What does this term correspond to? Short a put. Okay, and why is that? Because I have the minus sign there, -1. This term corresponds to a bond, long a bond with face value X. And it says that's equal to 1 share of stock. Okay. So when I see these formulas, put call parity, when I look at them, I read them as a portfolio. It's telling me this portfolio here, long a call, short a put, long a bond, is the same as a share of stock. Okay, so that's the way you should read that. I can rearrange this formula. So in this case, in this problem, I was dealing with the put. I was dealing with the put being mispriced. So what am I going to do? I'm going to rearrange this formula. And I'm going to rearrange it for the put. So rearrange put call parity to solve for the put, for the price of the put. Okay, so let's do that. So I come up here and I'm going to rearrange it. And so, well, let me first rearrange it in terms of the payoffs, right? And then I'll go to put call parity. So from my formula up here, from my formula right up here, I'm going to rearrange this, right? I'm going to come down here. And if I solve for the payoff of the put, what am I going to get? I got to rearrange this. I'm going to get C sub T. What order did I put it in here? Minus S sub T plus X. So all I did was I took that, the formula circled in green, and I solved for the put payoff. What is this formula telling me? This formula is telling me the following. So it's saying long a put, that's the payoff of the put, is equivalent to long a call, short the stock, long a risk-free bond, again with face value equal to X. And I can actually verify this if I wanted to with the payoff diagrams. And so if I rearrange this, so this tells me a put payoff is actually equivalent to this portfolio here. Okay, so two things that have the same payoff must have the same price. And that's how we did put call parity. So if I price each of these things, so on the left, I'm talking about the price of a put, that's P0. On the right, I need the price of the call, that's C0. I need the price of the share of stock, that's S0. And I need the price of this bond with face value X, that's just the present value of it. Okay, and this was just rearranging put call parity. So essentially all I did was I rearranged put call parity. All right, so why did I walk you through this? Why did I rearranging this and stuff? Because what put call parity is telling us is it's telling us there are two ways to buy a put. Okay, there are two ways to buy a put. Let's write this down. Two ways to purchase a put. Okay, so method number one, just buy a put in the market. Okay, and if I do that, how much is it going to cost? Let's remember our market price. It was $1.50. That was the market price. So that's one way I can get a put. Okay, and let me write this down again. Actually, that was P0M is equal to $1.50. Okay, so that's the first way. If I want to put, I can just go buy one, and I look up the premium, and it's $1.50. There's a second way to buy a put. Okay. What is the second way to buy a put? It's to use put call premium. Because put call premium, if I look at this, put call premium says, let me highlight this up here. Put call premium said that, hey, another way to get the payoff of a put is actually to go long a call, short the stock, and long a bond. That's another way to buy a put. Okay. How much does that cost? Put call parity tells me how much that costs. That's what put call parity tells me. If I want to buy a put, but I don't want to do it directly, I want to do it through this portfolio, put call parity tells me how much that will cost. So the second is buy the, I'm going to call it the put call parity portfolio. that replicates the put payoff. The price of this is given by the put call parity formula. What was that? That's what we calculated in that first example. That was $2.02. Yeah, so this is saying that this put is priced at $1.50. But if I look at the other securities, if I look at calls, stocks, bonds, everything else, that implies that it should be worth $2.02. So I found something that's underpriced. I found it's too cheap compared to other things in the market. So that is what put call parity is going to allow me to arbitrage off of here. So what's going to be my arbitrage strategy? So the first thing to note is that since the prices are different, and what prices am I talking about? The market price versus what put call parity says the price should be. Since those prices are different, the law of one price is violated. Why is the law of one price violated? Because in both cases, I'm just buying a put payoff. Here I buy the put directly. Put call parity says I can buy a put payoff as long as I use a call, short the stock, long the bond. Those are the same payoffs. In one case, I can buy it for $1.50. In the other case, I have to pay $2.02 for it, but I'm getting the same payoff. So the law of one price is violated. So I can arbitrage. So how am I going to arbitrage? Let's look at our arbitrage strategy. All right. What's always our approach to arbitrage? Buy what's cheap, sell what's expensive. Okay. Buy whatever is cheap. So if I look here, what is cheap? The put in the market, the put at the $1.50. So again, always think buy what is cheap. Okay. And what is this? This is the put in the market. So that is okay. And then I need to sell what's expensive. What is expensive? The put call parity strategy. Put call parity says, hey, you can also create a put through the strategy, but it's going to cost you $2.02. So that's what I want to sell. So let's go to that. I'm going to sell what is expensive. What is expensive? This is the put from put call parity. Okay. And in fact, the put from put call parity, we said, how much does that cost? Well, I need to use the put call parity formula. So the price of that is a call minus the stock plus at present value there. And we had calculated in the previous example that that was $2.02. So I want to sell that. How do I sell this? So I want to sell this. How do I sell this? Somebody tell me that the strategy of selling this put call parity relationship. So look here, again, every time I see this formula, I think of a portfolio. This says long a put. Why is it long a put? The coefficient is 1. Long a put is long a call, short the stock, long a bond. Okay. I don't want to buy this. I want to sell it. So if I want to sell it, I'm just going to multiply this equation by -1 on all sides, right? So that's going to become a minus. This is going to become a plus. This is going to become a minus. Right now I'm messing up my formula here, but so then this would be a -202. So this says to sell it, what do I need to do? Well, look, I need to be short the call. So I need to sell a call. What do I need to do with the stock? Buy the stock. Does everybody see what I'm doing? I'm going along the coefficients here, and I need to short, or I want to sell the bond, right? And remember, the face value on the bond needs to be X. So this is my strategy. This is my strategy. I'm going to buy a put for $1.50, and I'm going to sell the same put for $2.02. How is it the same put? Well, it has the same payoff. It has exactly the same payoff. So I'm buying and selling the same payoff, but I buy it for $1.50, and then I get to sell it for $2.02 through the put call parity formula. So what is my profit here? So my profit, I'm going to, at time 0, how much money am I going to get at time 0? I'm buying something for $1.50. I'm selling something for $2.02. How much am I going to pick up at time 0? Yeah, it's 52 cents, just the difference between these. So I'm going to earn 52 cents right now, okay? So that's great. I'm going to make 52 cents right now. What happens at expiration? What's my payoff at expiration? No, it's not going to depend on the stock price. Why? Because I am long a put. I bought the put in the market for $1.50. I'm also short that exact same payoff. That's what put call parity allowed me to do. That's what this relationship said. It said, hey, if you want to sell or short that exact same payoff, you can do it by this strategy: the sell the call, buy the stock, sell the bond. And so my payoff at T, those are going to cancel each other. I'm long a put payoff, I'm short a put payoff. It's going to be 0. So this is going to be an arbitrage. There's arbitrage. I make 52 cents. No risk. Never have to invest anything. I just make 52 cents. All right, you look confused. So ask the question, because there's a bit to absorb here. Okay. Yes.
We're selling it to someone else in the market, even though we bought it on the market at a lower price?
No. So what was our strategy here? So let's go up and let's highlight the strategy. So what did I do in my strategy? I bought a put in the market. So I bought a put. Cost me $1.50, but I'm long a put. Okay. Then I turned around, and what did I do? I sold a put payoff. I didn't do it directly. Put call parity tells me that if I do this strategy from put call parity, which was sell the call, buy the stock, sell the bond, that just corresponded to the put call parity formula, then that's selling a put payoff. So I bought a put payoff, and I turned around and I sold the put payoff. Okay, it was just disguised. Put call parity says that this is sort of a disguised version of a put payoff, but it's exactly the same as a put payoff. So what does that mean? I buy a put payoff, I sell a put payoff. I'm out. I'm never going to have to pay anything because I'm long and short the same thing, a put payoff. So what do I receive from this? Well, I just look at how much I paid for both of those two things. Well, I paid $1.50 for the put that I bought, but I received $2.02 for that hidden put payoff that I sold using put call parity. So I just pocketed 52 cents. And I don't have to worry about it at expiration, because at expiration, I was long a put and basically short a put payoff. They just cancel each other out. Does that help?
I get it in terms of.
Yeah. So here's the practicality in the market. So say you go into the market and let me erase some of those. This is going to get kind of. All right, so it is not so much. Okay, so we use terms like selling a bond. It's a risk-free asset, a risk-free asset. I often call it a bond in here, but it's a risk-free asset. And what's our notion of a risk-free asset in general? Should know from 340. What's our risk-free security? Money market, a money market account. It's safe, risk-free, you earn an interest rate. That's what we're talking about here. Okay. So when I say so here, when I'm saying you buy a bond, let's do it the easy case. You buy a bond. What am I saying? You just stick some money in the money market. That's what it's saying to buy a bond. Sell a bond would mean what? It would mean you borrow money. It would mean you borrow money. So you can borrow money, you're trading on margin, you borrow money. So the interest rate there would correspond to like your margin rate. So in practice, that's what it corresponds to. That bond corresponds to, I probably shouldn't call it a bond. It's a risk-free security. It's like a money market. You're either putting money in the money market or you're borrowing money. And borrowing money is trading on margin. No, so this is all it says to do. It says, okay, go look in the market, and there's the put price. Calculate from put call parity what it says the right value for a put is. Okay, so we did that, and we got $2.02. So something is wrong with this market, right? But put call parity is telling us a put should be worth $2.02. Why in the world is it selling for only $1.50? This market, something is wrong with this market. In fact, it's so wrong that you can arbitrage off of it. How do you arbitrage off of it? Well, look, that put in the market is underpriced. That's way too cheap. I want to take advantage of that. How am I going to do that? I'm going to buy the things that are cheap. So I'm going to buy a put. Unfortunately, I don't want to be exposed to, buying a put. Right? Because, if the stock goes up, I might not make any money. So what am I going to do? I'm going to buy the put for $1.50. Turns out I can essentially sell a synthetic put at the same time. What is the synthetic put? Put call parity tells me how to create a synthetic put. How do I do that? I sell a call, I buy the stock, I sell the bond. That's what put call parity is telling me. How much do I get by selling that synthetic put? I get $2.02. Wow. You bought a put for $1.50. You turned around, sold essentially the exact same thing, just a synthetic one for $2.02. You just pocketed 52 cents. That's an arbitrage. I don't know if that helps or not, but that's a good answer. All right. Other questions on this, because this is one of the key ideas, and this makes the pricing that we get in options, things like put call parity, a very strong theory. Why do I call it a strong theory? Because it says if the theory is the prices don't line up with the theory, somebody can make money. So if we look in markets, markets are going to line up with put call parity, at least within reasonable bounds. You know, you have bid ask spread, and you have maybe different rates on borrowing rate versus, you know, investing, and that would come in the risk-free rate. But otherwise, markets line up with this. Yes. Yeah.
So say like if the next example, but the price per change.
Yep.
Or the split. So then you would be buy or call, sell the stock.
That's right.
buy a bond.
Exactly. You just flip this because this says if I want to buy a put, look on the other side. It says to buy a put, I buy a call, short the stock, buy a bond. And again, when I say buy a bond, that's just basically investing money at the risk-free rate. It's like putting it in a money market. And then the top, what would I want to do here? I'd want to sell this one. So I'd want to short a put. So let's say this price instead were $2.50. So then what do I want to do? I always want to compare the two. Which one is cheaper? I want to buy what's cheaper. So I'd like to buy for $2.02. That means buy the put call parity strategy. And then I'd want to sell the put in the market for $2.50. And that would be my arbitrage. So then I'd pick up the difference there, the 48 cents. Does that make sense? So it's a little bit tricky to, how much time do I have? Do you want to go look in, let's look at some prices. Do you want to see if it satisfies put call parity? Let's see at least how closely. And the problem is we don't have interest rate and we're going to get bid ask spreads and stuff. And the market's not open right now. So let's look at whatever the quotes are, but let's do it just for fun because I don't have a lot of time left anyway. X is corresponding to the strike. We can pick whatever strike we want. Pick whatever strike you want. Maybe I'll go to Yahoo Finance. I'll just get some option prices. Which one do you want to look at? You tell me the underlying. Now watch, it better line up with put call parity or I'm going to be. You want to do the Russell? Yeah, let's do Russell 2K because that's it's European. It's on an index. No, Russell 2K is small cap. Yeah. Is 3K mid cap? But that 3K is large cap. We'll do Russell 2K. So why is it good to do Russell 2K? That was a great one because this is an index option. Index options are European. They tend to be European. And we're talking about put call parity for European options. So that's perfect. Right? The American option, then you got early exercise, which is possible. All right, let's go pick some of these out. Let me pull up Excel. We'll do our little calculation. Or actually, do I need Excel? Maybe I need Excel. All right, let's go down. So give me a strike. What strike do you want to look at? And then we'll look at the prices. 2240. Okay, so we're going to look at strike 2240. Let's do a calculation here. We're going to do put call parity. So X is 2240. Okay, so that's good. So down 2240. This is the call side, right? Oh, see. Can we do one that's more at the money? I'll tell you what I don't like about that. It's because the minimum tick size down here is it a penny? I didn't think it was a penny. Anyway, my concern is that the bid ask spread is going to be pretty big, and that's going to, yeah, let's try 2215. Okay. I didn't want effects like the bid ask spread, and I don't know whether they're using mid price or last price or whatever to throw it off too much. All right, which one do you want to? We can solve for the. Let's put in the call. Okay, so the call 2215 is $2.22. Let's not even look at the put first. What is the price? Okay, 2214.96. So this would be S0. Did I get that down right? 2214.96. Let's get a risk-free rate. Risk-free rate is almost zero. Okay, so I don't know, maybe I'm just gonna use some small number. We'll see how far off it is. And then what's time to expiration? That's what was bad. Okay, sorry, I messed it up because that one's expiring today. Let's do a liquid one. That'd probably be the October 15th. Is that the, I want to go to the third Friday. Sorry. Yeah, here we should get, see this one, we're going to get more reasonable prices out there. We were talking about, so let's change these numbers. 2220, let's go to 2220. Let's go to the call price, 2840. That's the same risk-free rate. Time to expiration. I'm gonna have to approximate this. October 15th, what is it today? What do we have? It's about a week and a half. Okay, I'm going to approximate this. You should do like number of trading days, but let's do a week and a half. And how many weeks in a year? 52. It's better to actually count the days. Exactly. Okay, so let's see what put call parity says. So let's remember, put call parity says the price of the put should be the call minus the stock plus the discounted strike. So I'm going to take the call minus the stock, plus I'm going to take the strike and I'm going to discount it 1 plus that to the, I'm just going to use that annual compounding. Hope that's close enough. 3312. Uh-oh, now the moment of truth. We'll see how close it is. 3597. Throw off a little bit. If I narrowed these numbers down a little more exactly, I wonder if that's so my guess is these are last prices. If you look at the prices during the day and look at like midpoint between bid-ask spread, it's going to adhere more closely during the day, because that would be a situation where you could actually go in and try to trade. Or if you look at, you know, if I go in, if I had to buy at the ask and sell things at the bid and whatever, and normally the markets will price things inside of put call parity, meaning when you take all the costs into account, there's not going to be a put call parity arbitrage opportunity. Because if they are, they're too easy. It's too easy to do. And you get hedge funds, which will just like scan for the prices, and a put call parity arbitrage exists. Others jump in and boom, they will grab it up. So that really forces all the prices to pretty closely adhere. So we were a little bit off here, but it'd be interesting to do it during the day and to get a better risk-free rate and account on the time. All right, anyway, fun to look at. All right, so I'm going to stop here. We'll pick it up here next time. And next time, where we're going with this, we're going to do put call parity. We're going to add dividends in. Okay, so we haven't been talking about dividends yet. We're going to add dividends in. You're going to see that's pretty easy if we think about it the right way. It's not going to complicate things much. And then do a couple more things, and that'll take us to the end of chapter 3. Hello.
Are you able to go over the different